Chapter 19, we're talking about the foreign exchange market. And, it goes into play because, again, like the textbook talks about, we are truly a global economy. So we've got businesses who are doing business, U.S. companies who are doing business with Japanese companies, and they're buying goods and services maybe in yen, or they're doing business with Mexico and they're buying goods and services in pesos. So that's what this particular part of the textbook is talking about, that there's a financial market that goes along with those foreign exchange rates. And the first section talks just about kind of how you can convert it. So every day there's an exchange rate. So like how many pesos can the US dollar buy? So if you went down to Mexico with $1, how many pesos would they give you? If you're using your credit card, say in Mexico, the bank will give you the best exchange rate. If you're using the hotel, a lot of times it's the worst exchange rate, and it changes over time. Those exchange rates fluctuate. And then there's an impact of that on business. So like I teach advanced accounting and we have a whole chapter on that you can see how a business that's doing business on a regular basis in the worldwide economy and is buying and selling goods in different currencies, how if the US dollar increases in value, then you would get, if it increases in value, you're going to get less of the foreign currency. But so say you're having to settle an accounts receivable in that foreign currency, then it's going to take more US dollars. You would get more of the foreign currency for the US dollars. But if you were buying goods, if you were going the other direction, then it would take more US dollars to buy those goods. There's a fluctuation there. And then like in an accounting, we'll map it out, like say, okay, this is our liability initially, this is how the exchange rate changes. And then you can kind of see it mathematically that then there can be gains and losses just based on what the US dollar does. And it has nothing to do with the business itself. So read a little bit about that because it talks about like if you have a strong currency, again, if the currency is strengthening, it can be destructive, you know what I mean? So even though we think, oh, that's a good thing, it doesn't always result in a good thing depending on if you're an importer or an exporter. And then it talks again about, well, what if the value's going down? And then recently, that's what we've seen in the past few years. The US dollar has been deflating as compared to the euro. And one thing that does result in is it does increase travel to the United States from our European countries. So the European countries, if their euro is if they can get more dollars for their euro, they'll come over here and go to stay in hotels and go to the Broadway shows and go to Disney World and take vacations and do stuff like that and do shopping because, again, they can get more product for their euro than they could if it was going the other way. So there could be some benefits, you know what I mean? There can be some benefits to that. So again, there's a nice discussion though in the textbook. So read over whether the US dollar, when it's inflating, when it's appreciating, what happens to businesses, and then when it's depreciating or going down in value. Because neither one of them are not necessarily, they can both have impacts, negative and positive, both directions. Okay, then the people who participate in the foreign exchange market are banks and bankers and financial institutions. And then there can be customers, which are normally large companies who are internationally trading or internationally doing business. And then central banks. And the foreign consumers, if they're going to want to buy product in large amounts of product in the US dollars, then they may want to kind of hedge those changes so they can enter into a hedging agreement to kind of work out if they're okay with where the US dollar is now compared to the euro or the yen or whatever their currency is. They can hedge those, and then the banks will take those hedges, and then it kind of creates a short-term market. So people like that are interested in it. Also, foreign investors who are investing in outside stocks and bonds of international companies would have an interest in this foreign exchange market as well. Then they get into the supply and the demand. So for the supply includes the people who have the currency and are interested in exchanging that currency for another form of currency. So then who has those? It's going to be domestic customers, domestic investors who want to make foreign investments, foreign firms that are selling locally, domestic tourists that are going to head overseas, and then central banks. So those are people who, again, have like the US dollar and would be interested in exchanging that for another currency. So those are our supplies. The demand for them, I'll list those out too, because I think I kind of shifted over that. But foreign consumers, people who are buying product in the United States, foreign investors who are making those, local firms with foreign earned profits, foreign tourists who are coming into the United States, and then central banks. So again, those were our people who demand it, and then there are people who supply it. So then, with basic economics, where those curves meet, or those, the supply curve and the demand curve meets, is kind of where that equilibrium price or that closing price is going to be. So as the demand goes up, that price, that price will change, or if the supply goes up, the price would change. So again, just kind of your basic economics there. And then again, so then that takes us to the next section where we're kind of getting to that point of equilibrium. And then we've got some terminology in there. There's the marginal propensity to import. So that is a change in the purchase of imports brought about by a change in the amount of disposable income. So I think that this section is one of your discussion questions, but if your disposable income is increasing, and you're not buying, so the textbook gives an example. So say the income of the Indian middle class people has increased, and they've bought things that are not made in India. Maybe they buy electronics made in Japan, or movies from the United States, or from outside. So then in that case, they're going to sell their Indian rupees, which is their currency, in the foreign exchange market to buy either US dollars, or the Japanese yen, or the Chinese yen, or whatever they need. So then that's going to increase the demand, which is going to shift the curve then. So the consumer's preferences for import does change, but it can put a change on that currency exchange rate. And then we can see that kind of happen. Then there is the total factor productivity, and that is a measurement of how efficiently and intensely inputs are used in the production of goods and services. So again, that's going to say, with our changes in preferences for imports, if we're importing more, that can also impact our exchange rate, normally not instantaneously, but over time. Okay, and then interest rates, it talks a little bit about those being able to change it as well. Another term that they use is purchasing power parity. So the exchange rate between currencies that equalizes the purchasing power of each currency by eliminating the differences in price levels in that economy. So that is going to be really, I feel like as I kind of look through that, though, that's really just the difference in our exchange rate. So it talks about if you're going to buy a good in the United Kingdom that's worth £1 and then sell the goods in the United States for $2. So there's going to be a difference in what you're buying it compared to what you're selling it at. But I feel like that would kind of go hand in hand with what the exchange rates would be at that time. But then it does talk about the change in the exchange rates can make the dollar overvalued or the pound undervalued. And then the differences in these actual price levels can also then put pressure on those exchange rates to kind of go up or down depending. And then the last section of the chapter kind of explains kind of how some of these foreign exchange markets have come into play. So there's a discussion about the gold standard, and then in which would have been prior to the World War I. Then in 1944, there was this Bretton Woods meeting where the United Nations came to discuss the financial crisis that was happening. So it was the Bretton Woods Conference. And then at that conference, the leaders discussed the question of how the World War II was interrupting the Great Depression and kind of what some things could be changed from that. So they kind of get into some of those details. And then that is pretty much it. So I feel like the topic of foreign exchange markets though is a high level finance topic. And like I said, we talk about it in advanced accounting. In advanced accounting, we do more of the numbers where we're looking at taking their financial statements and converting them into US dollars, and or looking at transactions that are happening with a US company when they sell and they close their sale in another foreign currency. How does that result in those foreign currency gains or foreign currency losses? And then when you really put the numbers to it, then that's kind of how you can see that there are gains or losses that can impact those companies. And then we take it one step further to say those companies that have a lot of sales in those outside currencies, and they don't want huge losses on their income statement that they can't control. Those are the businesses that enter into these foreign exchange rate markets where they're hedging it. They're going to say, I want the US dollar, if it's right now takes $1.20 to buy €1, I'm going to hedge that for 60 days or 90 days so that when I have to pay the bill that comes due in 60 days or 90 days, I'm going to pay it at that $1.20 no matter what happens in the market with the US dollar. So you can hedge a variety of transactions that way, but then that way they're kind of secure from those gains and losses when the US dollar moves, when it fluctuates. Or there are investors who then just play the market. They estimate, I think the US dollar is going to go up, so they're going to enter that market, or they think it's going to go down and they'll enter it. So it's a way for finance people who can kind of make some interpretations of the market and estimate where the US dollar is going. It's a way for them to make some money. But again, it's more of a high finance topic. Most people like you and I in our 401ks, we're not playing in the foreign currency exchange market. It's more of a high finance type of a deal. And banks definitely enter it because of all the international business.